Main takeaway is we were waiting for the 10 o'clock hour. This is that silver bullet that I was giving you in the Twitter space. Some of the newer folks are like, what'd you say? Silver bullet? What's that? Silver bullet trade, ICT, is a setup that will form every single day. Every single day it will form. And what you're looking for is between 10 o'clock New York local time and 11 o'clock New York local time. There will be a displacement in a direction that you should be anticipating. Once that displacement occurs, you're waiting for a fair value gap to form. When it does, you're going to be expecting that to be traded into and then repriced to a pool of liquidity that would be opposing your entry. For instance, what we're outlining here. We've already seen, a small minor delivery of it. I mean, it's been 5 handles or so since that run in here. But the expectation is for you to anticipate this formation in price every trading day. Every single trading day it will form, which is why I call it silver bullet. It's a move that will always be there. They will never be able to hide it from you. They're never going to be able to change it. Nothing's going to change it. It's always going to be there. There's never any reason for you to doubt that it won't exist. Okay, and it's also a way to train yourself patience, teaching yourself patience, sticking to a model and some rule-based ideas, and those being you're looking for 5 handles. That's it. As a new student, as someone that's just now starting to become interested in the marketplace, it's a little intimidating, isn't it? Who do you listen to? Who do you trust? What do you waste your time on in the beginning and regret later on? And you want to avoid that. You want to go to the people that have the best stuff. You're thinking that there's a system or a teacher out there that's going to teach you how to never lose. They don't exist. I'm not that guy. So there's a lot of things that go through your mind when you first get involved in all this stuff. So I try to be as responsible as I can and say things like, you're going to practice in a demo. You're not going to trade with live funds. You're going to decide if you ever decide to do that. I don't ever tell you to do that. But I promise that you're going to see things in price that are very consistent. They're rule-based, structured approaches for you to go in and study like a laboratory experiment. If I was to say to you, go out there and find some random fair value gap and pick a sell side or buy side liquidity pool, and good luck at it. Right away, 90% of you are going to be like, what am I supposed to do with that? This guy's not teaching me anything. Versus, okay, if I tell you, if we are looking at a time window, very specific time window, 60 minutes, okay? Inside of 1 hour, you can find a 5-handle run that's reasonably easy, in my opinion. And of course, my opinion is biased because I've been doing it a lot longer than you. But out of all the things that I teach, I think that it's visually easy to see a fair value gap. It's easy to see that. But it may not be easy for you right now, but it's easier to see that than a breaker. It's easier, way easier to see it than determining what order block to trade off of. There's a graduation between one PD array and understanding it to the next, but you only need one. The silver bullet is a time-specific setup that forms between 10 o'clock and 11 o'clock. And I know you're already going to ask, why does it only work in 10 and 11 o'clock? Well, that's the morning session silver bullet. There's an afternoon session that I'll teach you later on. But between 10 o'clock and 11 o'clock, what you're looking at is the last portion of the move that's going to unfold just for that AM session. And you're right in the heart of the move. And fair value gaps are generally forming after a move begins. There's an inception of a move that you missed. That's like selling short above old highs. You didn't get in it. You weren't able to do that, but you don't need that. Like I was teaching with the 2022 model, you don't need that to be able to do consistent setups. Between 10 o'clock and 11 o'clock, you are in the heart of the AM session move, which is essentially between 8:30 in the morning to 11 o'clock. It can go as far as noon, the beginning of New York lunch hour, but it's, again, a graduated thing in terms of time. There are macros that exist in price where between 9:50 and 10:10, in that 20-minute period, generally you're going to see a price run that begins within that 20-minute span. The move begins in those 20 minutes. It's not the entirety of, I mean, obviously it can, I mean, a fast move or a fast market, it can do that. But what you're looking for is a run that begins between 9:50 and 10:10. That's the macro. It starts doing its run between those two time windows. There's another macro that exists at 10:50 and 11:10. There's two macros that start in those two hours. The silver bullet is specific to the 10 o'clock to 11 o'clock hour. And what we're looking for is an obvious pool of liquidity that has not been tapped into or engaged, which I've mentioned, obviously, with the lines here, you see it. You're not demanding that you capture the daily range. You're not demanding that it goes to your technical target. You're only expecting it to give you your 5 handles. Big paradigm shift there, because a lot of you also are taking this idea and trying to make more of it than it really is. Will there be times when that move is a significant higher low of the day and it just keeps on running? Yes. But in the beginning, you don't know when those are going to be there. You don't know what that criteria is to cause that. That's a whole lot of other things that you have to learn progressively over time. So I'm reminding you as gently as I can to stick to the rules I'm telling you to stick to. And that way you won't be taken into these false expectations that it's going to do much more than it's designed to do. Between 10 o'clock and 11 o'clock, identify liquidity, find a fair value gap. The fair value gap has to be opposing, in other words, opposite to the direction that you anticipate the liquidity to be drawn to. For instance, fair value gap after displacement lower, we wait for it to trade up into the fair value gap and then trade towards a pool of liquidity lower in the form of sell side. If you're bullish, you're looking for the market to trade higher, displacement higher, leave a fair value gap below market price, then trade down to the fair value gap, and then gravitate towards a pool of liquidity, which would be buy side that hasn't been engaged yet, and it has to have better than 5 handles in terms of the range from where you think it might get to. Not that it needs to get there. Remember, I'm teaching you how to look at price, removing the necessity of being right, because right is not, it's not a destination. Being correct is not a destination. Excellence in execution is, and it has a very small population. The only way you get to be a member of that is by doing the things I'm telling you to do and avoid the things I'm telling you to avoid.